We are not in the business of philanthropy. We're investing. We are looking for returns. We are looking for our money to grow. So you have to go in with a mindset, how do I make money for this investor? You shouldn't ever go into a meeting with an investor and say you have absolutely no competition. There's always some kind of competition out there. If you do have an idea that you want to just vet, find some friendly investors you can just start having that conversation with, so you're asking for advice and not asking for money.
Welcome to the latest episode of the Raise&Exit podcast. Today with us, we have Kristina Montague, and she's here in a dual role. She's both here, the managing partner of the JumpFund, but she is also the recently appointed chair of the Angel Capital Association. So she's bringing not just her own wisdom, but the wisdom of dozens, hundreds?
Hundreds.
We're about to find out.
Thousands, actually, of angels.
Perfect. So Kristina, over to you to just introduce yourself a bit more on bringing a perspective today that is more from the earlier stage, the angel stage, for founders that are trying to figure out how to kind of raise their next round or stage of their business. So over to you.
Yeah, great. Well, thanks for having me, Edgar. Always excited to share more with founders. We know it's a rocky road out there, but we want to be clear and transparent on our end as investors to sort of, what our expectations are and how you can best position yourself. So, I think at the top level, I always say be prepared, understand what the kinds of different opportunities are for raising capital from debt to equity, even crowdfunding, all different sort of platforms you can use now, and what is right for your business. So that is the first step, I think, is that preparation and education. And we actually provide a bunch of that at the Angel Capital Association. That is also, I think, very good for entrepreneurs to know. So kind of understanding the other side of the table as well. So that would be my first piece. But
that's very helpful on that part, because I think what you're just pointing to there, I think, is also very important. People are at various different stages of knowledge around what the fundraising environment is, right? Like even as you just went and said, like the way that there's debt instruments that are available for you today that might not have been, right? Like you look at kind of like the legacy, like started in a garage stories and they put $20,000 in their credit card,
yeah,
right? Like that's not the only option these days. Or you go and hear about like, they showed up at the VC and they got a $250,000 check off of their 10 slide memo. And it's like, listen, like that's like a 1 in 3 million.
Absolutely.
Typically that's there. So I think what would be very helpful, Kristina, is I don't want to kind of put a damper on expectations as much as I want to elevate the responsible expectations. Yeah. So can you speak a bit more as to kind of like that universe at those earliest stages of, I've started a company, or I want to start a company, I have an idea, and like, how do I get through the stages that you're involved in or exposed to, like the angel check, even like call it the pre-seed in many of these situations, and somewhere at the equivalents of like friends and family or alternatives. So over to you on that.
Yeah, so I mean, there are many steps within there. So you're not usually these days going to get a check on an idea, or even if you have some IP, if you haven't really kind of kickstarted the customer exploration and had at least early feedback and some traction there, and show us some kind of traction, whether that's just people saying, yes, I will buy your product at X price. It's very unlikely you're going to kind of go on that wing and a prayer thing. And we have entrepreneurs all the time coming to us. I have this great idea. I think that's going to make, hundreds of millions of dollars. Well, great, but you got to show me how you're going to do that. And then what kind of early traction can you show us? So different angel groups and different individuals have different markers for that. But usually ideally we would like to see some real dollars in. Like, for instance, one of our companies, she started out of an accelerator program, kind of cobbled together with some different existing tools. Even at that time, she used Zoom. It was a licensing company for therapists.
Yeah.
And she kind of had a proof point of her first $8,000, had about 10 clients pay. And we're like, interesting. That is interesting now, because you have shown that there is some market there and there's an opportunity to build on that. So it was only just $8,000 of traction, but that showed us that there was a there, right?
Yes.
You have to have some kind of proof point. And it used to be like, eyeballs, a bunch of these people are looking at it, but social media that's not a thing you can tell us anymore, that you've got, 10,000 people following you on Instagram. Well, great. Have they bought anything from you?
I
they said they would buy anything.
I love what you're saying that, Christina, because one of our earlier guests on the series went and talked about like, there's a portion of the series, is like the seed or the Series A community where look, they want to invest into something that has like a really, really big upside, and they want to kind of get the understanding of it. But what you're really pointing to here is you also need to demonstrate that you have a responsible floor, and that you've actually gotten a piece of that floor. And I think that sometimes is forgotten about by people in kind of taking an idea and turning it into a business. And then at the stage that you're talking to, it's actually taking that business and demonstrating it as a scalable business that needs that check to be able to take things to the next level. So thank you for kind of putting that pragmatic realism that's in here. That's fantastic.
Sure, and then you can take that, not, that initial traction you have, and develop your pro forma around it, and say, in 3 years, given this early traction and where we think we're headed, and the market, opportunity that we think we can be at 20 million in 3 years, and we think we can be at 100 million in 5 years, and this is how we get here. Now we know we're going to slice and dice that, like we're going to cut it back down to something more realistic. But if you can show us that path early on, that's when it becomes interesting, right? Because we're looking for a return.
Yes.
We are looking to model everything initially to at least a 10 times return on our investment. That's our modeling. So we know that we might get 3x. We know we might just get our money back, right? But we're building a portfolio of companies that over all of those companies, we can prove out at least an average of all those companies, a 3 to 5x return. And so we've got to have some companies that are going to hit that 10x or more. So you've got to model for us early on how you are going to get there.
That's so good, because there's something also you said a bit earlier, because you talked like being the chair of the Angel Capital Association, and you have thousands of members, but it's also thousands or hundreds of investment hypotheses. So how can a founder approaching angels or angel networks kind of save everybody some time in figuring out who they are a fit with and who they're not a fit with? Like, what are some questions they want to ask themselves, or call it ask of their own business or their business model, that you think would just save everybody's sanity?
Yeah, well, I think it's researching those organizations. There's a lot of material out there now. You can research most of these funds and networks. So the angels work in groups. So we work at networks, like member networks. And sometimes those member networks have funds attached. So sometimes when you're going to the group, you actually get the opportunity to pitch kind of to the fund as well, or the fund might invest alongside. And then we have strict funds like I have, which are the traditional kind of like a VC fund, but we were really early stage. So we kind of play with the angels. And so when you're doing that, you want to go out and you want to do your research. What is their investment thesis? Do they have anything online you can read about of what they invest in? And really make yourself, a spreadsheet of the ones that fit your business. First of all, you shouldn't be pitching to people who are not interested in your type of business. If they mostly invest in SaaS, don't go to them with a CPG company. Go find those investors that first have that interest. And then also you have impact investors out there. So ones like ours, which are interested in investing in female founders, right? That was our thesis from the beginning. We only invested in female founders in the Southeast. Yeah. I've had hundreds, maybe thousands of people come to me, a lot of spam too, and outreach for money. I have, men doing that. I have people outside of the Southeast doing that. They didn't bother to read our thesis, which is pretty basic.
I think that's an interesting point that you're going, though, because I actually view doing your basic research as signal of your sophistication.
Absolutely.
To be invested into. Yes. Maybe that's step one. Have you done your homework on who would fund you?
Yeah.
Right.
And do your own due diligence is what I say, because you should also start looking at who they have funded. And if you can, reach out to those founders and ask them, how were they as a funder? How were they? That's
interesting. So go to some of the other funded entities in the portfolio and say, hey, what's it like? Would I be a fit?
Right.
Oh, that's very cool source of signal, Kristina. I actually haven't thought of it that way.
You're doing your own due diligence. And some people do this as they kind of get more in. If they have a little bit of traction with a group, they want to say, okay, I need to figure this out, because there's good money and there's bad money out there, and there's money. All money is not the same. So you don't want to just take any money for your company. You want to partner in this. And particularly your really early investors are going to be your champions. And they're going to be the ones that can be really close to you. They could maybe be an early board member for you. They can definitely be a mentor and advisor. And, if you're able to get to that upstream capital, those relationships do change. And like the venture capital and private equity have a lot different expectations for you than your early stage investors. But if you can find that right fit early stage angel type investors, then they want the best for your company. They're going to get in there and they're going to roll up their sleeves with you. That's what we like to do best, and really engage with our companies early on. So you want to have that, I say it's a marriage and a divorce all wrapped up in one. You want to find the right partner, you want to have a good relationship, and then, you want to have that exit be as smooth and everybody kind of gets the piece of what they want and everybody walks away happy, right? That would be a good divorce. You don't want to mess with that divorce. So, your paperwork will help with this too. But I think, doing that diligence on the front end. The other thing I say to prepare is if you're not at the stage you're going to have a full data room, understand kind of the basic checklist for due diligence, and have as many of those materials ready. You can have them in Google folders, you can have them on Dropbox, you can have them any way you want. There's a lot of better platforms now for that, Notion or other things. And have those all ready. Have it turnkey. Have it easy. Because the minute they say, yes, I'm interested, I have some more questions, boom, you can turn that to them. And you could also do an FAQ. So as you're starting to have these conversations with investors, they're going to be asking a lot of the same questions. Those questions probably are also red flags to you that you should say, I probably better think about this more because it's not coming through in my deck, or it's not coming through in the material I've sent over so far. So if you can have those FAQs that once they start asking questions, say, oh yes, these are all the questions people have been asking. Here are the answers. And here are the links to the documents. And just be prepared. So, we've had entrepreneurs come to us that do not have their financials in a row. They don't even know what a cap table is. Like, you can't go out to investors be unprepared, because that immediately is, a red flag to us. And if we don't feel you're prepared on the front end, then we don't feel like you're going to run that business in a way that we are going to eventually see those returns. Yeah. So being prepared is the best thing. And that goes back to education. So then go and get the education around what kinds of documents would be expected in that data room, what kinds of things that they're going to ask for in a due diligence process, get a hold of a few diligence memos. I mean, you can find all this stuff online these days. And if you go to the Angel Capital Association, we have something called the Angel Box, and that is for groups and funds that are forming, but there are diligence checklists in there. You can find these materials on our site. So encourage you to just go out there and dig for some of this information that is readily available.
I love what you're saying there. And what you're also kind of alluding to here is there's a different level of diligence requirements at the stage of a company as well. Like I find that there's some companies that are going to raise, like what we've addressed here is kind of like being underprepared. But I would also assert that there's others who have gone in and overinvested, right? Like if you're going and seeking an angel check, you do not need a complex shareholders agreement that people are coming into. Most of the time you can get away with a safe agreement, right? So can you say a bit more of like, sorry?
So we don't love safes, but sure.
Okay, but I think what I'm trying to point to is that there is an over preparation. So is there areas where you would say like there's an over preparation or an unnecessary investment that people should be cautious of as well if they're at this stage of raising capital?
Yeah, I mean, I do think you should have a good lawyer at your back if you're going to start having conversations with investors, but I don't think you have to, go deep into that early on. You don't have to have documents already prepared. Sometimes you want to leave that door a little open. You don't want to, if you have a preferred method of a term sheet that you want, I mean, like, let's say you are going to do this on a safe. So you're only going to want to find those investors who want to invest on safes. There are a lot of investors who won't invest on safes.
Can you unpack that a bit more, though? Because you said you're not a fan of safes. And I like hearing this, by the way.
For investors. Safes aren't good for investors. If you're a VC investor, you're a larger investor that has a lot of money and you're kind of doing spraying and praying, which is like you're just investing small dollars in a lot of companies, then you can take the risk on those early safes. And this, of course, safes are done a lot more on the West Coast, and I'm in the Southeast. They've become more familiar. A lot of early stage companies are using those. The problem is there just aren't a lot of safeguards in there for the investors. And so people tend to hang onto their safes too long, and they don't turn. So like I have a company that I've been in 5 years, and that safe is still sitting there and it hasn't turned to equity. So like, are they ever going to have an equity raise? They keep just building on the safes and they take more debt.
So, Kristina, have you been engaged for 5 years without getting married under a term sheet?
Exactly. Well, the term yeah, exactly. It's the engagement. Yeah, it could be considered maybe it's not even a prenup, right? And but convertible note provides us more protections because there's a term limit on that. Usually we're going to extend it, but in some circumstances we don't. There's interest accruing on it so that when it does convert, it's more favorable to us. Sometimes safes have a few of those things, but most of the time they don't. So for us as investors, it's just a lot more risky, I would say. And so I understand why entrepreneurs use it, because it's easy. It's a simple agreement for equity. But we don't get equity until you raise your equity round. And so if you're not getting quickly to that point, then it's just a struggle for us as investors. But different investors are different. Some people are fine with safes and they're totally cool with that because they probably do a lot of them. And the other thing is when you have a safe, they're going to continue to push you to raise an equity round. So just know that just having the safe doesn't mean you ever don't have to raise equity, because we're only going to convert when you have another raise. So
it's so good.
I
just like these nuggets, these little nuggets, Kristina. It's like you got your data room checklist, you got your due diligence checklist, but I think what you're also kind of going and doing is like I got a horrible analogy, but it's almost like the Tinder checklist, right? Like, what are the requirements to swipe left versus swipe right? And like, because it's a mutual, right? Like, this is I think what sometimes I find founders don't recognize is that this is a mutual action. They're not people that are cutting a check to you or giving you money blindly. This is a mutual commitment. I think they always frequently underestimate the time period. Like the reality is probably 8 to 12 years in terms of how long you might be in a relationship with each other. Yes, everybody wants to get out in 3 years or get to 100 million in revenue in a year like Cursor or something like that. But like those are like 1 in a million, 1 in 5 million companies that are like that. So say a bit more about kind of going back to our original theme of like that pragmatic realism without dampening your idea. What would you add is something that founders should ask of themselves that is that would kind of maybe get them out of like almost myth bust themselves? Like, what are the myths that founders have around this process that you'd like to have it be busted before they even speak to you?
Yeah, so I think scalability. Is this product or service really scalable? And you can do your, here's my total addressable market, here's what piece of the pie I think I can, get. Is that realistic? Show some comps, right? You shouldn't ever go into a meeting with an investor and say you have absolutely no competition. There's always some kind of competition out there. So maybe it's not direct competition, but what is something like what you're doing enough? Or something bigger than you that you could easily do what you're doing, right? Be aware. Be very self-aware. And I think the other thing is, this doesn't happen as much anymore, but it does happen sometimes. People being a little too private with their idea, right? And so they have this thing that's their baby and they're building it, and they're reticent to share the full kind of behind the scenes with an investor because they think somebody's going to steal their idea. Nobody has the time or money or energy to steal your idea and do do with it. Now, a private equity person might do that, but
you're pointing to something that's interesting here, though, right? Because I think people like decouple like IP that they've actually developed with a business idea, right? Like if you're actually working on a patent that you want to turn into a business, then yeah, you can have that two-stage thing. But if it's just like the business idea, I want to solve for something in the world, you want to get the signal from the prospective investor that this is worth solving, right? I think that's what you're kind of pointing to, right? Like, and I think we need to decouple fundamental IP that has been developed, could be in a lab, could be, in a research paper, whatever the heck it is. But the business side, you want to decouple the business side from the legally registered IP when you're raising capital. That's what I'm hearing here. I want to switch a little bit to the other side of your role on this call today, which is being the managing partner at the Jump Fund. And you talked about your thesis a little bit earlier in passing around how you want to invest into women founders, etc. And look, we keep seeing the statistics. I've been seeing the statistics for decades now around just underrepresented founders. The reality is we have a societal cap, right? We just have a kind of like a groupthink around female founders. What is a way that a female founder or a wannabe female founder can kind of snap themselves out of the societal groupthink? Like, what is one way that they can recognize that, shit, I should do this. I'm a female founder. I have a great idea. We have a greater investment environment than ever before. What's something you would recommend for them to ask themselves or, have as an existential conversation?
So I wrote a book called Jump In, and it's about taking risks. And I think, how do we sort of coach ourselves to stop kind of looking for the perfection and just do it, frankly, and just go out there and do it and literally jump in. Even though the waters may be cold, maybe swimming with sharks, you have this passion within you, so go and do it. I think women want to be over-prepared sometimes, and so they hold themselves back from that. And I don't think people say it's risk aversity. I think it's a wanting to be prepared and to be and also we want to do things to a perfect level sometimes. Mm-hmm. Like we want it to be, I swear the guys go out there and they're just shooting from the hip and they're like, hey, I have some great idea. Yeah, I have some buddies who might, come around and invest with me. Yeah, this is awesome, and the women are like, oh my God. I think also for women, it's really important to find that support group around you. So whether that's get in with some other women entrepreneurs, there's so many great collectives now, whether they're virtual or in your backyard, and then start talking to some women investors. And so whether you are ready to go with your idea or not, this is a little flip of what I was saying earlier, but if you do have an idea that you want to just vet, find some friendly investors you can just start having that conversation with, so you're asking for advice and not asking for money.
Yes.
And that helps you start forming those early relationships. If you get a little light bulb on in somebody, that's somebody you could keep going back to and saying, I've gained a little traction here. I've had this great customer conversation here. What do you think now? And eventually that actually might lead to money in the end. But you've had that. So we had early investments in the Jump Fund. We were talking to companies for over a year. That wasn't diligence. That was just them keeping in communication with us until they got to a point that we were like, oh, that's interesting. You just got $1 million grant from the Department of Energy for your small scale hydropower business. Mm-hmm. Okay. It's gone from, basically the IP, the idea, you have this unit. Now you have interest from DOE. Now you can further your research and development. Oh, and you have an early customer, in an energy company. So then the light bulbs turn on. We're like, yes, we want to come in now. So having those conversations early on. So I think it's finding community. It's also being educated. So it goes back to, I think really helps women is to get really educated and feel kind of more grounded in the whole ecosystem type. Like, what's the language? How are people building these companies? So it doesn't have to be just women investors. Just get in with your local ecosystem and start kind of learning and being engaged in that, and don't be siloed in that. That has been really helpful. So we have, one of the things we've done at the Angel Capital Association and Jump Fund have been a part of is growing women's capital. And so we have been part of this, what we call the next wave of investors, that has grown from about 5% of angel investors are women to almost 40% of angel investors are now women in about a 10 to 15 year period.
That's amazing. I actually, I didn't realize it had grown that much.
Yes. Yeah. And that's, a large part of that, the much larger groups like Golden Seeds and some of other sister organizations. Some of that are kind of upstream VCs that are doing early stage investing as well. And women understanding this is an asset class that I can invest in, women coming into more money, that, that wealth transfer is going to be huge in the next 20 years. And so we're trying to harness more women's capital. So there is more women's capital that's coming off the sideline. And not just because you're a woman, that doesn't mean women will be friendly investors, but there's more opportunity to have those early conversations and vet your company and have kind of a friendly first entree if you're kind of feeling like it's such a boys' world out there, right?
Yeah, no, I love that, because that is the coverage, right, Kristina? I think that's the problem. That is the coverage. If we look at the mainstream media coverage that is there around most startup success, right? It is heavily oriented towards younger male founders. We don't even have a lot of coverage about older founders been doing it. Like I look at like the statistics that are out there, like one of the best ages to start a business is in your 40s or early 50s. But we sensationalize the younger generation because it's the better story. And I think we're getting the wrong signal in the public domain for what would go and make a female founder go and have what they need as conviction or confidence to go and actually pursue that business idea that they have. And that's something I kind of add here. I want to pick up a little bit on what you kind of also been, I don't know, I've been seeing this in the background of what you're saying. What is a get past this in your head before you approach an investor? Like what is one thing you say? It could be like a myth, it could be a false premise. Like what's something that you're like, get past this and you'll have much better success?
Well, the one myth I always hear is that people just want to give you money for your company. We are not in the business of philanthropy. That investors we're investing. This is just like you would invest in public markets. We are looking for returns. We are looking for our money to grow. So you have to go in with a mindset, how do I make money for this investor? Even at a very early stage in a company, when you don't have that all charted out, you've still got to basically BS charted out. You've got to make a plan of some kind and show, hey, this is where I think this is going. We know that things are going to pivot all over the place in this process. Your customer base may completely change in the process, right? You may find that there's a totally different group of customers that gravitate toward this and will pay for it versus the ones you thought to begin with. Want you to see us as investors and partners in what you're doing and not as just the check, right? And so too many times I think there's this myth, and particularly because we're called angels, we're working on that because is that the right way to, we're early stage investors. So we're taking greater risk than any other, besides your friends and family who like you. We're taking the most risk because you are at your earliest stage. And so you've got to prove it to us at a very early stage when you're not probably making any money yet. How you're going to make us all money. That kind of myth busting around that about just I need people to just write checks for my company is one that we always have to kind of get over, and particularly with that angel mythology that we're somehow philanthropists in this. They are usually high net worth individuals or groups of people, right? Or funds that, yes, can weather storms. But we want all our companies to be 10Xers. We don't want them to be failing. So we're going to really push you. The VCs are, once they come in, you have to have that real revenue traction, usually. There's some earlier stage VCs now. And they are going to push you to grow really fast. Like they want you to churn and burn that capital and grow as fast as you possibly can, right? And we're okay with you being a little more patient, a little more efficient, but we're looking for that growth too. So that's something that I would say is kind of a myth that's out there, particularly around the angel type investor. Yeah, that would be the biggest one. And then I think that we also, on the flip side of that, if we're writing the check and we want to be engaged. So you're looking for partners. Mm-hmm. So sometimes we're strategic partners, but mostly we're just like those people who can really be with you in this very early stage of your business and help be mentors and help bring you along through it. So you do want to do, again, that vetting to make sure that they can really add value. And we always asked, the entrepreneurs, what questions do you have of us? And the most savvy entrepreneurs would have good questions of us as investors to vet whether they thought we were the right fit or not.
Kristina, this has been a source of so many nuggets. I'm going to have to dissect this interview after the summary on it. I really appreciate it. For all of you who are listening or watching this, we're going to have all the links to both the Jump Fund and the Angel Capital Association for you as well. Please reach out to Kristina. The contact information will be there. Thank you again for joining us, and look forward to our next conversation.
Thank you so much, Edgar. And also, a lot of this information is in my book. So look for Jump In, Women Investing in Women on Amazon. So
beautiful. We'll have a link to that too.
Great.
My interview with Kristina Montague was very refreshing because I think what it did is just got us out of the trap that so many people get into as to what to expect when it comes to going to people and looking to have them invest into your company. And I think one of the big ones is the perspective that people have around angel investors as somebody who can just go and, cut your check because, oh, they believe in it and it's fine if they go and lose that money. And I think that is a really, really false impression. And if I kind of extrapolate more from that session with Kristina, what did I really, really get? Be very clear on who you're going to and why, and how are you going to go and make them money, and really get them to commit to be without that money for other purposes from anywhere from 5 to 15 years. And I think it's that sense of putting yourself into the shoes of the people who are cutting your check, of having a bit of that humility will actually go and make a better rapport and avoid the type of issues that people go and run into when they're going and looking at getting money from investors. And if I jump it from the angel side, where we talked about with Kristina, to some of the horror stories that you sometimes hear about founders or founding teams being removed by venture capital boards later on, you got to be very clear. How do the people that you're going to go and raise money from, or if you're selling your business to private equity or to a division of a major corporation, how do they operate with the teams and the companies after? Do your homework. I think that's probably the biggest part that's there. And you might not just have that circumstance to go and do so, but really it is one of the best things that you can go and do, is to do your homework, figure out how you're going to go and bring value, figure out how they're going to go and bring value to you. And then from there, you're going to find out that you actually probably have a much smaller list of people to go and raise capital or to sell your business, but be able to do it in a way that is a better of a win-win for everybody involved. So on that note, till the next episode of the Raise and Exit.